Welcome back, fellow investors. As a dividend growth investor, it's so hard to find stocks with a nice starting yield and at the same time good dividend growth opportunities. And if you find one, it doesn't automatically mean that those are great companies to invest in. So in this video, I'm going to talk about a stock which just hiked their dividend by 9% this week. I'm going to show you what this company really is about, what you should know if you want to invest in it, and what I'd pay for the company if I really wanted to own it now. Having said that, let's get started, and the company I'm going to talk about today is Viatris. If you haven't heard about Viatris yet, this is a recent merger between Milan and Upjohn, a former division of Pfizer. The merger happened on November 16, 2020, so it's not too long ago yet, and that's why there's limited historical information available. But what we do know already is that the company has organized itself around three business units. The first one is their brands, and you might know some of them because they have really the iconic brand of Viagra, but also the biggest selling drug at the moment is here Lipitor, which is bringing in around 1.2 billion per year at the moment. A slightly smaller business unit is their generics business, and you need to think here about over-the-counter products that you can easily get at any drugstore. They're covering effectively all the therapeutic areas that you can imagine, so probably there's a high chance that you're using one of their medicines if you're a patient in one of these areas. Last but not least is their biosimilars and complex GX business unit. This is really a business unit with lots of growth potential, but it's really trying to get a big share of the blockbusters from the big pharma companies that are going off patent. It tries to be the first one to file for biosimilars so that they get the first entry and the first movers advantage in those markets and really outcompete the existing players by offering much more affordable drugs than the on-patent drugs. And we're not talking about the little ones here, because it's trying to go after Humira, the biggest selling drug in the world from AbbVie, but also the top product from Roche, Herceptin and Avastin. So if it could just only get one of these, it could already bring in multi-millions of dollars just alone from their biosimilars. So in its concept, this sounds promising. So what are the plans after the merger with this company? So they have really seen 2021 as an in-between year. Get their act together, get some cost savings realized, and prepare themselves for the future. They also mentioned already that they wanted to establish and initiate a dividend in Q2 2021. That's what they did. They paid an 11-cent quarterly dividend, and they just recently announced in the news that they hiked the dividend to 12 cents going forward, which means a 9% dividend hike. This is a really decent dividend hike because the company is already trading at a 3% yield. So the current yield at the moment is 3.3%. And if as dividend investors, we love this because 3.9 is 12. This would give the perfect valuation from the Chowder rule point of view if it continues to do this for the next 4 or 5 years. At the same time, what the company really needs to do is pay down their debt, and they've been doing that already. More about that soon. So what management is telling is that this period of delever and rebalance will take about 2 years, and then they are focusing on durable growth. And here again, they expect to grow the dividend to further reduce their leverage. But what this company is really about is new pipeline investments and M&A. This is the bread and butter, and this is what they need to start focusing on soon. Because if you look at this company, it's all about portfolio management. They've been so far just buying a lot of drugs and businesses. So what you can see is they expected some business erosion last year, for instance from Lipitor, declining sales, some compensation with new products, but at the same time also expenses increased, and then synergies, the cost savings that they're really talking about. Hence why they are able to provide such a guidance. But this was at the start of last year, so how have they been doing so far? Well, so for me, the Q3 reasons were really good. And they just told me that management is really hitting every mark. So if you really quickly look into it, the highlights here, they raised full guidance for 2021, which was a really great accomplishment. At the same time, they were already able to earn some money from new product launches. But what is the best here, what this company really needs to focus on, is that they already almost paid down 2 billion in debt from their cash flows. So they are well on track for their 2023 target, and as we know by now already, they increased their dividends even. At the same time, they have been making their cost savings. I'm sorry for the employees because around 20% of the employees they are cutting from the workforce at the moment. So that's really not nice. If you're an employee, I feel for you guys. But from the other side, the company is really doing what it's promising. So this sounds really good. Let's also quickly look into their top products. So here we can see Lipitor, 1.2 billion in the first 9 months. Norvac, Lyrica, Viagra. It's funny, I thought that everyone in the world was using Viagra, but still not the best-selling brand that they have here. Also, Xanax is here in the key segment products, might be also known by some of you. So what I really like about this is a portfolio which could have been constructed by a dividend growth investor because it's really nicely diversified with an outlier here who sounds more like Microsoft in my portfolio, but really a nice product portfolio in my opinion. So far, this all sounds really great, right? So what's happening with the share price then? It was an $18 last year. It's now trading less than $15. So how is this possible? It all sounds so good what management is showing you, but hey, maybe it's this. EPS seems to be in the minus. What's happening here? So let's look a little bit under the engine of what's happening with this company, but stay with me, guys. I will try to do this quick, and it might feel a little bit more technical now, but it's important for us to understand the numbers to see what the true earnings power is. If you feel that you don't need this, then just scroll forward to the next chapter in this video. I will talk about the valuation. And by the way, if you like this so far, then don't forget to like and subscribe. I'm trying to build this channel, so every little bit helps. So I always like to go to Morningstar for this, because it gives me a nice overview of the top level numbers of this company. And what we can see here is that the trailing 12 months it earned like 17 billion. At the same time, a cost of revenue of 12 billion, which gave it a gross profit of 4.7 billion. This is not a lot if you think about the margins. This is a gross profit margin of 25%, but if we then look at the operating income, it's even in the minus. This explains the EPS. What we can also see here is that there is a trend of declining cost of revenue, which is great. There's also a trend of increasing revenue. And what we can also see is that in the last quarter, they actually made a profit again. And I think this is also due to the decline in total operating expenses. So to understand what's really happening here, and if this is the execution of management strategy, we really have to go into latest 10K, because the companies are legally obliged to explain everything what's happening with the numbers. So let's have a look into it really quickly. So this is the last 10K of Viatris. We don't need to see everything. We just go back to the income statement, and what we can see here is the same numbers again. We can also see that the third quarter earnings were 26 cents over here. What's good to know, when companies have a lot of one-offs, which it suggests this company has, they always put some adjusted earnings in there. And I also found them in this document. And here I think everything is explained. So if you go to page 70 of this one, you can see it. Purchase accounting related amortization is part of the cost of sale. 920 million in this quarter alone and 3.3 billion in the entire year of 2021. Also, we see here acquisition related cost, also 150 million just this year, and also restructuring related cost, $741 million this year. And if we then go, we can see it here, ABC. You can read it. What it all says is that this amortization of the purchase accounting inventory fair value adjustment related to the combination, and with the combination they mean Milan and Upjohn. And here you can see it already, 1.2 billion respectively. Acquisition costs related to the legal and consulting fees, and also here for the last three, charges of 150 million are including the cost of sales. So this is explaining a lot. We're talking here already about 4.2, 4.3 billion in, you could consider one-off costs related to the acquisition. This is a lot. So if you remember the earlier earnings again, we're talking here probably about a 2.3 billion in real earnings bottom line for the company. They mentioned 3.4. I find it a little bit on the high end. And the reason for that is if we go to the cash flow statement, we can see that the company actually also generated 2.4 billion so far in real cash flow. It has hardly any capital expenditures. As you can see, it's also hardly doing any R&D, this company. Like I mentioned, it's more like a company of acquisitions. So this is almost pure cash that's going to the bottom line of the company. So just so you know, I read the full report. These are the few highlights that you need to know, which really shows the true earnings power of this company. So now that we have seen these numbers, let's also really quickly look at the narrative of the management in the latest press release. So and this is what it's telling us, and I'm not surprised, it is increasing its financial guidance. Revenue guidance will be up to, let's say, 18 billion almost, and the free cash flow guidance range from 2.4 to 2.6 billion. So approximately 2.5 billion they are expecting in free cash flow over the whole year. So there will be still a little bit of free cash flow in the fourth quarter, and I wouldn't be surprised if they even beat their own guidance for the full year of 2021. Having said that, what this tells me is that the company is really in a strong position. It's really hitting the mark, and the earnings look actually much better because these costs will fade away in the upcoming quarters. At the same time, they've been paying down debt. I'm not going into the balance sheet here, but I can tell you the balance sheet actually doesn't look that bad. They have a debt to equity ratio of around 80-90%. That's all you need to know. There's some goodwill on there that you might expect some amortization, but I tell you the debt will be paid off quicker than what potential write-offs will be with their impact to the balance sheet. So overall, I think they're really quickly beefing up the balance sheet, which is good for us as shareholders and exactly according to their plan. But hey, the risk is that I'm becoming overly bullish on this company already right now without even having done my discounted cash flow analysis. So also let's look quickly into the risks. And these risks are real because the company already announced that there is further erosion or declines to be expected from some top brands, especially the number one brand. So take this into account that there will be a bit of impact on this on revenue. And as we saw earlier, they try to compensate that with new revenue and further cost savings. But really, it's also a story of acquisitions and not R&D. So in this case, it is really depending on what they can acquire in the market, what's out there to really replace the lost revenue. And this really requires some strong business acumen. But so far, I'm having a lot of confidence in this management. But hey, the third risk I see is rapidly increasing interest rates. We saw already from the income statement that they are paying around 480 million in interest. So any rapidly increasing interest rates could really take away some flexibility from management in executing their plans. Okay, so the fourth risk that I see is the exposure to China. I mean, many people are bullish on China and entering the Chinese market, but I'm not, because China is really heavily and strongly pushing for the volume-based procurement plan. What this really means is that they are getting 80 to 90% discount on medicines that they are importing into China. It's really a low margin business, and for a company like Viatris, they should be there from a brand power point of view. But when it comes to profits, don't be overly excited here. Having said that, these are 4 real risks that I will keep an eye on in the upcoming annual report and the upcoming quarterly reports in 2022. Okay, so now that we know this, let's have a look into what I think this company is worth paying for. And a full disclaimer, I don't own any shares yet at the time of making this video. So based on some back on the napkin calculations, we have a market cap of 70.8 billion at the moment for Viatris. Free cash flow, management guidance 2.4 billion. I have no reason why not to believe that. It would give us a price to free cash flow of 7.4. Imagine where the market is today now. This is like 30% of what other companies trade for. At the same time, if we look at the real earnings power that I just showed you, I think it's approximately in line with the free cash flow. So here also like a PE of 7. This gives us a dividend yield of 3.26% just after the 9% dividend hike, which is a payout ratio of approximately 25%. Now, as you all know, I'm a conservative investor. I'm conservative in the numbers, but look at what the analysts are thinking. 6 analysts think that Viatris will earn next year $3.7 per share in earnings. This would give the current company a multiple of 4.5 to let's say 5. This is really cheap from that point of view. This is what these numbers tell me, so now I'm really looking forward to what my cash flow calculation says. By the way, if you're not aware yet, I'm keeping an overview of all the calculations I did before of the other stocks that I discussed in the videos in this G-sheet. You can get access to this file by signing up to my mailing list via the link in the description below this video. This way you will also stay informed when I publish any new articles on my European DGI blog. If you are already a subscriber and can't find it, please just drop me a note and I'll reshare it with you. So now that I've shared this, let's go into the calculation. So what I'm using here is I'm using the 2.4 billion in free cash flow as per the guidance of management. As I mentioned before, I'm quite okay with this number, I can understand it. So for the growth rate, this is not a fast growing company, guys. This is a slow growing company, so don't expect any miracles here. So I'm having a baseline case of 4% growth over the next 4 or 5 years and then a 2% growth, terminal growth after that. I would need at least a 10% annual return from this company going forward, and I believe that the company should trade at around a terminal multiple of 12. I give this scenario a 70% probability. As you can see, I've got also a more optimistic case with 6% growth rate and then 3% thereafter, and a really bearish case that almost nothing is happening and just a 1% growth in the first few years. Multiples are a little bit different. So based on this, I can now show you what I believe the intrinsic value of this company is, and I believe it is worth around $27. Remember, it's trading 40.74 right now. Hence, I believe that this company is heavily undervalued because my buying price with a 20% margin of safety in case I would be wrong is $21.50. It means that the company, in my opinion, is currently a 45% discount. And this should come as no surprise, guys, because the earnings per share are already trading around 2 if we look at the net earnings per share and if we take all those merger and acquisition adjustments into the context, because that's fair in my opinion. Having said that, I'm going to buy this company. I'm really happy with what I've seen. I'm very bullish on this company. So expect me on Monday to put a buy order out there and buy at least 100 or 200 of these shares. But hey, one more thing before you go. Click the video on the left side of your screen if you would like to learn how to do a discounted cash flow yourself. And click the video on the right side of your screen if you would like to learn in a similar way what I think about Visa's valuation right now. Having said that, everyone, have a great remainder of the week.